Hello everyone, welcome to Global Online. This is Dr. Swati. Your educator is here. Today's we are going to prepare for NTA UGC NET June 2024 cycle for the Commerce and Management. In today's session, we are going to take a rapid revision with the most expected MCQs of the business economics. Okay, so before we start, let's quickly I will tell you about our new batch will be going to be started from the 20th of the May. Okay, and here you will get complete course on commerce and the management. Daily live lectures will be providing over here, and the recorded lecture is also available in the app. The complete syllabus notes will be provided in the PDF format, and full syllabus mock test will be going to provide. More than 4000 MCQ series with a detailed explanation will be going to provide. PYQs with a detailed explanation is going to be provided. The complete paper 1 is free of cost if you register yourself for the paper 2, and for the paper 2, if you register yourself, we have Global Online provide you 20% of the discount on the fees, and in this 8000 rupees you will get paper 1 plus paper 2. And the contact number is given in your screen with which is WhatsApp only. For any inquiry you can get in touch with this contact number. So how to download the Global Online? Go to Google Play Store. Okay, and here you can download the Global Online and open it and register with your number, and then you go to my course and search the whatever the course you want. After that registration, you will get all the materials in the proper folder. So the all the folders having the video lectures with the materials, so you will get all the things in a very well manner. Okay, so let's start with our first question that which is in your screen. Which of the following is called as a Gaussian first law? So the Gaussian first law is a the first law is the option is given in your screen, that is the law of substitute. B, the law of equimarginal utility. Option number C, law for diminishing marginal utility, and the law of the indifference. So what is the Gaussian first law? The Gaussian first law give the two laws, that is first the second law is law of equimarginal utility, and the first law of Gaussian is a law of diminishing marginal utility. So the option number C is the correct, that is Gaussian first law is a law of diminishing marginal utility, and the second law is a law of equity marginal utility. So the Gaussian first law, the option number C is the right answer over here. So next question which is in your screen, the doctrine of the consumer surplus is based on. So consumer surplus, the consumer surplus is also given by the Gaussian. Okay, is given by the Gaussian, and the consumer surplus is what the consumer want to pay and what he actually pay. If the consumer want to pay 100 rupees for a product but he actually pay the 80 rupees, so whatever the difference have, that is a 20 rupees is a having the consumer surplus. Okay, so actually what happened, the consumer want to pay more, and here he pay the less for this goods. So here the satisfaction level of the consumer going to be surplus. That why consumer surplus. So the consumer surplus is the based on the law of diminishing marginal utility, which is given in your option number D. Okay, so the option number D is correct answer for this question. Now the manufacturing of the TV set and the mobile phone and their pricing in India belong to which one of the following market structure? The options is given in your screen, that is a monopolistic competition, perfect competition, monopoly, and the oligopoly. You know that market structures are divided in the many markets, like a perfect competition, like a monopolistic competition, like a monopoly competition. Okay, oligopoly, market. So these are market structure like this. What happened, the question is about the TV set and the mobile phone. You know that the TV set and the mobile phone having the varieties of the products available in the market. That means so how do you the question is that how do you differentiate this product? How do you differentiate this product? How do you differentiate? So how do you differentiate? Differentiate the product like their brand, like a Samsung, LG, okay, by the brand name, or by the quality, okay, or by the his price. So the customer differentiate his product on the basis of his brand, on the basis of quality and the price. So whenever these kind of structure you will find in the market, so it comes in your mind that is it is a kind of a monopolistic competition, because the feature of the product differentiation is it will be found in the in the what, in the monopolistic competition. So the option number A is the correct answer for this question. Okay, in the perfect, what happened in the perfect competition? In the perfect competition, there is a there are the many large seller and there were many large buyer, and the products are homogeneous. What? Homogeneous. In the monopolistic competition, the product is also homogeneous. There is a heterogeneous product, but there, these heterogeneous products is further classified in the product differentiation. Okay, now the monopoly, in the monopoly only the one seller is available. Okay, in the oligopoly the few sellers is available. Okay, so now the next question which is in your screen, the long run production function is called the production function. You know, see, you know that the production function is run by two way. It is a short run, by the short run, or by the long run. Okay, so what happened in the short run? In the short run, the variability we will find and the fixed factor we also found it. Okay. And but in the long run, because the duration is too long, that's why the only and only variability is found over there. Okay. So that's why the only where the variability, only the variability is found. In that case, the law of return to scale apply. Okay, law of return to scale apply. In case of variability and some factor is also constant, which having a fixed factors, in that case in that case law of variable proportion is applied. Okay, law of variable proportion is applied. And you can see is talking, the question is talking about the long run. So long run, it is having the only a variable. Okay, and here the option number A, that is return to scale, is the right answer for this question. Clear it? Now for next question which is in your screen, that is for a good supplied by McDonald and the Burger King, cross elasticity of demand will be positive, either negative, or zero, or infinite. So let's understand the question before we going ahead with the options. First, understand what is McDonald. Okay, McDonald and the burger both having the similar goods near about. So what they have, they are the substitute, of each other. Okay, clear? So when the substitute, when the products are closely substitute, and what happen if the McDonald price is going to be increased? What happen if the McDonald's going to be increased? The demand, what effect on the demand of the Burger King? The Burger King demand also going to be increased, because price increases of the McDonald, the consumer of the McDonald goods going to be shifted to the Burger King. Clear it? If the price of the McDonald is decreases, so what happened? The Burger King's demand as the consumer is going to be shifted to the McDonald. So demand is also going to be demand of the Burger King. Burger King is going to be decreased, and here is a demand of the price of the McDonald. Okay, so here you can see the price and demand of the one another product, substitute goods, having the positive. What? They are positive, and the price is increasing of the one goods, the demand is also increasing of the another goods. Okay, so in case of substitute goods, there we will found the positive relation. What we found? There is a positive relation. So for the substitute goods, the relation will always be the goods will be always be positive. Okay, so these are the substitute goods. Now for the option number A is the right answer for this question. Now, yes, next question. The Gaussian's second law state that, you know that in the first question we discussed about the Gaussian's first law. Now it's about the second law. Second law is related to equimarginal utility. Okay, it's about the equimargin. Now, what is the equimarginal utility? Say, let's the first statement is given, when the income increases money value and the real income will be decreases. No, the equimarginal utility, equi means equality. Okay, so here you can see any kind of equality. No ma'am, so there is a no connection of this. Okay, now the second option, which is a one, a person has spent his entire income, he would have maximized his total pleasure from its only if the satisfaction gain from the last item of each commodity bought was the same. So this is the equimarginality. What does it mean? It means that if a person spent his entire income, so when he consumed the two product, okay, product A and product B, in that case, what does after consuming the last unit of this A product, he and after consuming the last unit of the B product, he will get equal satisfaction. So this is a equimarginal utility, and this is the Gaussian second law. Okay, so the option number B is the right answer over here. Okay. Now, next question which is in your screen, under the perfect competition and individual supplier is, what happened for the perfect competition? In the perfect competition, is individual supplier is there? Yes, ma'am. In the perfect competition, individual supplier is there. Okay, so what the role of the individual supplier in the perfect competition? You know, is it a price maker? Is it a price taker? Is it a both of the above and none of the above? So what will be the right answer for the competition market? We know that the supplier, either it is individual, either it is a group, they are the price taker instead of price maker. They are taking a price. They are not having a thought. Why they are taking a price? Because many or the large supplier is available in the market. Okay, but when it is a price maker, when the who make the price, who is having the monopoly in the market. Okay, so the option, this question, the option number B, that is a price taker, is the right answer. Okay, now the statement is given in your question. Let's read it question very carefully. Statement one, number one is given, the pricing below the market price. Pricing below the market price of existing brand is considered to be most reasonable pricing strategy for a product which is being sold is a strongly competitive market. What is talking about? He is talking about if the price we set very low in the market, so what happened, it will be reasonable pricing strategy. Yes, and it is strongly competitive market, it's role in a strongly, because if we set our price in a very low, so what happened, we will compete in the very strong competitive market. So it is a reasonable. So yes ma'am, the option number one is the correct over here. Now the option number B. Option number second is that pricing above the market price has been found to be more successful when the seller intend to achieve or prestigious position, okay, among the seller in the locality for the selling prestigious goods of which of the prestigious of goods of the much superior quality. You know that when the goods is called as a prestigious, when it having the high price, okay, like a gold, like a diamond, okay, these having the prestigious cars. So these having, why they are prestigious, because they are pricing they are set their price above the pricing. Okay, so for that the pricing above, and it's a relation with way more successful when the seller tend to what to achieve the prestigious position in the market. Okay, so that's why the statement number two is also right. So for this question, option number A, both statement are correct as the right answer. Clear? Now next question which is in your screen, which of the following is not a pricing method? It's not a pricing method. So pricing method, the option number A, seasonal, option number B, cost plus, option number C, promotion, and option number D, A and C. So what is a what is a pricing method? Pricing method is a cost plus method is a pricing method, and all these seasonal, promotional, these are not the pricing method. So for this question, option number D is the right answer. Okay. Now next question, in dash price fix pricing fixed cost are excluded. Where the fixed cost of the price is going to be excluded, is excluded from when we added, when we when we produce, additional unit. Okay, when we produce additional unit, in that case we cannot include the fixed cost of the product. Okay, so in that case, price scheming is that, or the going rate price is that, or the administrative pricing, or the marginal cost pricing. So whenever the additional unit is about the additional unit, in that case marginal cost of pricing is the right answer. Clear it? Okay, so the option number D, that is marginal cost pricing, fixed costs are excluded. Okay, now next question, in short run, monopolist. In short run, the monopolist is what? The, you know that the monopolist is the having the long run also, and also classified in the short run also. Okay, so he is talking about the short run. In the long run he can earn the super normal profit. Okay, but what happened with the short run? In the short run, he either he break even, that means cost, marginal cost is equals to marginal revenue. Okay, incur losses, that means the marginal cost is greater than the marginal revenue, or the making a profit, that means marginal cost is less than the marginal revenue. Okay, so what is going to be happen, is happen that in the short run these all things there is a might be happen. So that's why in the short run the option number D is right, that is a break even, or incur losses, or making a profit. And so all of the above, this is the right answer for the short run. Okay, now which one of the following does not explain the basic nature of the business economics? So what is a business economy which is not explained? Here is using the word that is a not explained. So let's go with the statements which is given. That the first statement is given, that is behavior of the firm in the theory of practices. Here you know that in the business economics study the behavior of the firm, behavior of the firm, like market structure with their market. If the behavior of the firm is they having the monopolistic market, if they having a monopoly market, if they are having a perfect competition market, or either they are a oligopoly market. So the actually what he is going to be study is studying about the behavior of the firm. So it is right in the theory or in the practices. So the business economics study the behavior of the firm in the theory and the practices. Now the second statement is about, let's leave the second statement, we understand the first is the C statement. Use of the tools of the economic analysis. Here we use a tools, in the economics we use a tools. Yes ma'am, we will use a tools. Okay, tools like a law. Okay, law of diminishing marginality, to evaluate to national income, how to calculate, and these are the what, these are all the tools of the analyzing the business economics. Okay, and clarifying the problems. What kind of problem? If the economic is growing, if the economic is rising or decreasing, what effect on the economic? So it is clarifying the problem for what the reason behind of the, that is the inflation and the deflation. Okay, so these kind of problem in the organization, and evaluate the information and compare the alternative course of action. Yes, we have to calculate in the business economics. Now the option number C is also correct over here. Now the let's move toward the D option, integration of the economic theory with the business practices. Okay, for the purpose of facilitating the decision making. here we integrate in the business of me. Can we integrate the economic theory? Yes, they have a many theories, and we will integrate. We can compare this theory with one another, and this is the business practices for the purpose of facilitating decision making. Yes, if the many of the laws and the theories is given in the economic theory is already available, so what happened, we will integrate this all the theory and make a decision according to our situation. So option number D is also right over here. Let's move toward the option number B. Distribution theory. Rent, wages, interest along with the theory of profit. Is it related? Is it directly related to business economy? Yes, it is related to economic, but not actually, because it's about the distribution theory. So it's not that they're giving the rent, giving the wages, paying the interest. It's not, it is a kind of it's related to the finance. Okay, so that's why it's not related to the business, directly related to business economics. That's why option number B is a not, is not. Okay, so the option number B is the right answer for this question. Now let's move toward the next question, that is a kinged demand curve. So found in monopoly, discriminatory monopoly, oligopoly, or the perfect competition. How is the king demand curve look like? So here you can see, is this like the king demand curve, and here you see there is a steady and then again is going. So this is nothing but, this is the average revenue, and this is nothing but a marginal revenue. You can see when the average revenue going to be decreases, marginal revenue also parallel to decreasing, and after the some time is going to be stable, and after the stabling this, after he is again going to be decreases in the similar way of the average revenue. So this is a king demand. That's why here is a, you can see there is a kingness is found. Okay, so this is a king demand curve. When this is happen, this is happen in the, when the firms had there are the few firms in the market, and these few firms having they run their monopoly, kinds of monopoly. How they run their kinds of monopoly, because in the few markets they are, if the one firm, if the suppose A firm reduces his prices, then the another firms, the another few firms, that is B or C, also reduces their prices. Okay, but what happen if the A firm increases his prices, so the B firm and C firm do not follow this. Okay, so that's why this is the king demand curve, and this is found in the oligopoly market. Okay, so the king demand curve found in the oligopoly market. So the option number C is the correct for the king demand curve. Clear it? Now the next question, that is Mr. Weber left his current job to find another job, would be the classified as frictionally unemployed, structurally unemployed, and the cyclic unemployment, and the D, no longer in the labor force. So what about the Weber? So Weber is working in his some job, and he's currently working. Now he's wanted to switch, or switch his job to the another job. So this is this kind of job, this kind of frictional employment, when the one person transfers employment from the one job to the another. So this is a frictional unemployment. This is a frictional unemployment. Clear it? Now next question, which is in your screen, method of charging low price initially. Method of charging low price initially means in the initial sale. If the diagram is like this, so here the seller charge a low price in the initially, then gradually going to be increases. Okay, so this is what gradually going to be increases. See, here is charge a low price. What is the intention of that producer? The intention of the producer, here is the best example of this is having the Reliance company, Reliance Jio. Okay, what Jio did is initially charge a low price to cover the maximum market. Okay, so this is a kind of market penetration. This is a kind of market penetration. Okay, so it is a market penetration. So now let's understand what is this market scheming. Scheming means where the seller charge a high price in the initial state, and then gradually he is going to be decreased. So this is the price scheming. Okay, what is called, this is the price scheming. Clear it? After that, next question, that is indifference curve which L shape represent. So in the indifference curve, L shape, either he said L shape or it says a right angle. So the indifference curve which L shape represent, it show the perfect complementary goods. Why, ma'am, it is a complementary goods? Why it is not a supplementary goods? Either it is a non-substitutional good or the non-complementary goods. So what is that? First of all, we draw the indifferent curve. Here you know that the indifferent curve is like this. There is a convex to the origin. Okay, is a convex to the origin. What happened if the price is this is a price, this is a normal price. Okay, if the price is increases, okay, so what happened if the prices increases, demand going to be decreases. Okay, so demand going to be decreases. You see, if the prices increases, demand going to be very highly decreases. So this is take a proportion. If the price is decreasing, the quantity is going to be increasing. So this is convex to the origin, but is talking about the L shape. So what happened with the L shape? If I, this is a indifference curve. If I draw, this is like this. See, this is a L shape. So what happened, you can see if the price of the one product is increasing, demand of the another product is also going to be increasing. So what happened, there is a positive relation. Okay, so in that case they are perfectly complementary. That's why the diagram is like that. Okay, when the perfectly complementary of the products, in then the indifference curve is a L shape, having the L shape. Here you can see there is a substitute of the goods. Okay, in the case of substitute, you can see the convex to the origin indifference curve, but in case of complementary, you see the demand curve is a complementary. Clear is? So the option number A is the right answer for this question. Now the next question which is in your screen, variable cost include. So variable cost include the cost which is vary from time to time. It's not fixed for all the period of time. So the premium, insurance premium, yes ma'am, insurance premium is fixed here. The specific amount you have to, like 599, like a 1099, like a 10,000. So this is the premium is fixed for the every month. So this is not a fair, this is a fixed cost. Okay, then the property cost, property tax is also fixed. There's no changing from time to time. Salary of the permanent employee is also going to be fixed for a longer period. After that, the promotion and all, they're going to be increases, but for the permanent employee, the price salary will be fixed. So what about the excise duty? Excise duty is nothing but it is a kind of tax. It is levied when the depend on the manufacturing of the good. If your increases your units, the tax is also going to be vary. Okay, that's why it is a excise duty is the B is the right answer for this question. That is the variable cost include the excise duty. Got it? Now, which of the following form of the which of the following form of market organizing assume that entry and exit A form is a costless means there is no barrier, in the entry and exit. Okay, so when this has happened, in the case of differentiated oligopoly, in the case of duopoly, in case of monopolistic competition, in case of pure oligopoly. You know what, duopoly, there when there is a only two firm is available in the market, two seller firm is having in the market. What is a pure oligopoly? There is a few seller. Okay, what is about the monopolistic competition? In the monopolistic competition, you can see there is a no entry barriers. Okay, and you also in the perfect competition is also having the same characteristics. Okay, so the option number C is the right answer for this question. Okay, now According to the king the demand curve model, the firm will be assumed that reveal firm will be. So what is reveal firm? Reveal firm means a competitor firm. Okay. So what about the reveal firm? The reveal firm maybe what they did, they do I have already said that if the two or three firms in the available in the king the demand curve, that means it's related to oligopoly. In the oligopoly, you see there are few sellers. Okay, if the price of if the a seller increase his price, decrease his prices, so what happened? B and C firm also going to be decrease their prices. Okay, but if the A firm increases his prices, so the firm B and C not going to increase their price because they want to capture the market of the A. Okay, A firm. So if they increase their price, if they did not decrease their prices, what happened? The customer of the A firm going to toward the B and C firm. Okay, so that's why the option, let's see the options. The firm keeps their rate of the production constant? No ma'am. The firm keep their price constant? No ma'am. The firm match the price increases but not a price cut? No ma'am. If the firm increases price, the firm the not price cut. So what if they are cutting their price? No ma'am. The firm match the price if cut. If they decrease their price, that means cutting means decreasing their price in that case, but not a price increasing. They are not decreasing their price, decreasing their price but not increasing the price. So the option number C is a correct answer. Okay, option number C is correct answer for this question. Now the next question, which of the following statement is incorrect? What about incorrect? Let's understand, see the statements. Even monopolistic can earn the losses. Yes, they can earn the losses. They can earn the losses. Yes, they can earn the losses. Then option number B, the firm is yes, we have seen in the previous slide that is in the short run, they either in their break even point, that marginal cost is equal to marginal revenue. They can either be in their losses, their marginal cost is greater than the marginal revenue. And they can earn the profit, marginal cost is less than the marginal revenue. So this all they can earn the losses. Then statement B, the firm perfect competition market are the price taker. Yes ma'am, they are price taker because perfect competition having the many seller and the many buyer. So that's why. Okay, in the what happened with the C, it is a C statement is always beneficial for a firm in the perfect competition market to discriminate the price. No, it's not beneficial for the perfect competition, because if they discriminate their price, they will not survive in the market, because there are the many buyers and the many sellers are available in the market. If they are thinking for the discriminating the price, they will not able to survive in the market. The customer is going toward the another competitor, they are shifting to the another competitor. So don't think about this. So the option number C is incorrect over here. King the demand curve is related to oligopolistic market. Yes ma'am, we have seen in the previous previous slides. Yes, so the option what is talking about the incorrect one. So the C is the incorrect answer. Okay. So thank you so much. And we are completed here the series of the one of the economics. So we'll continue with the next video. So till bye and take care.